What's up, everyone? My name is Michael, and I'm with the Trading Analyst. Today, we're going to talk about something that's been on everyone's minds lately, the stock market and the potential for a recession. We've seen a lot of volatility in the markets over the past year, but what can data analysis tell us about when the stock market will bottom out and when a recession might begin? Michael Burry's recent tweet made me revisit some material. In 1907, the failure of the Knickerbocker Trust due to risky bets caused a panic that spread to other banks. The panic was resolved when J.P. Morgan made a stand 3 weeks later. Burry's tweet suggests that a similar situation may be happening now, and we could be near a market bottom. Today's stock market brief will cover interesting charts and the economic and stock market cycles. We'll also discuss finding market tops and data that suggests we may be near a bottom. Welcome back. Let me show you this chart. It helped me spot a potential stock market top. The blue line represents the business cycle, while the stock market leads it. The 11 sectors of the S&P 500 are also shown. Now, when energy stocks began to outperform, I suspected a top was near. Then, defensive sectors started to outperform, and I was more convinced. Do you remember how last year ended? Energy was up significantly, and staples, healthcare, and utilities also performed well. Those sectors outperformed as the market turned downwards. Later on, financials also performed relatively well with an 8.31% increase for the year. But here's where it gets interesting. Check out these charts and data indicating we may be near a market bottom. In 2022, bonds were outperforming commodities, and utilities were outperforming the SPY on a relative basis. This also happened in 1999 and 2008. As you can see in this chart, there's a historical correlation between bonds outperforming commodities and utilities outperforming the S&P 500. It happened in 1999 and 2008. And we're seeing it again now. However, with the recent drop in commodities, particularly oil breaking this potential head and shoulders neckline, there are indications that a recession may be near. The recent move made commodities underperform bonds, causing utilities to potentially outperform the S&P 500. The correlation between the two recently broke, as seen here in the updated chart. Now, this chart from March 2022 is showing the correlation between rising oil prices and both recessions and bear markets in the stock market. Every time the rate of change of oil prices reached around 100, we saw major market crashes such as in 1987, 2000, and 2008. I questioned whether we would be able to avoid a similar outcome this time. An updated chart shows that the rate of change of oil prices has recently crossed above 100, potentially signaling a recession ahead. The updated chart shows a negative rate of change and a significant drop in price. This could indicate a looming recession. Another chart we need to pay attention to was from December 2022. The red line on the BKX chart seems to be where the price goes just before something bad happens. This was evident in the financial crisis, the Christmas Eve massacre, and the 2020 pandemic. Looking at the updated chart of the banking index, it's clear that the index took a big hit and is now down 26%. This was just one of many warning signs of a potential downturn. But now, let's focus on the signs that we could be nearing a stock market bottom. Let's look at the business cycle chart with the blue portion representing stages 6 to 1. We're likely transitioning from stage 6 to stage 1 or 2, which means stocks, bonds, and commodities will decline as the economy deteriorates. We're already seeing this, with financials and commodities taking a hit. Stage 1 marks a contracting economy with bonds turning up and interest rates declining. This favors loose monetary policy and is bullish for bonds, and we've already seen a surge in bond volatility recently. Bonds may be starting to turn, but it's too early to tell due to high volatility. However, significant moves like these indicate that something big could be happening. As bond prices rise, yields are coming down. One key point is that we're now seeing a potential shift towards a reduction in the effective federal funds rate. The Fed is currently focused on combating inflation, but recent events with banks may lead to a change in strategy. Also, meeting probabilities suggest that a reduction in rates is being considered. Could this mean that we're heading towards a full recession? Several signals suggest so, including the outperformance of utilities, the collapse of oil, and the rise of bonds. It may take some time to enter the recovery phase. Interestingly, technology, communication services, and discretionary stocks tend to perform best during a recession, although it doesn't necessarily mean they will start to rise. They simply perform better relative to the S&P 500. Looking at the year-to-date performance, the sectors with the highest gains are discretionary, communication services, and technology. As we move towards a possible recession, certain stocks are gaining momentum and performing well amidst the market volatility. Let's highlight some of these stocks in the technology, communication services, and discretionary sectors. Starting with discretionary, Amazon's chart has been flatlining. It could be basing out or in an accumulation phase, indicating the market may be bottoming out. Apple's chart has also been stagnant for about a year, holding up well amidst market volatility. Even if it were to hit its 2023 lows, the price would just be in a range, potentially building a base to bottom out. Moving to communications, Meta has been a strong performer, currently breaking new highs. Even if it were to fall back into the previous range, it would have to drop significantly to invalidate its long-term potential. I'd like to end the video with this chart showing how every time the market hits a bottom, volatility spikes past the 40 marker. The pandemic shot up to 82.5, while previous events like China's stock market turbulence, Operation Twist, and the financial crisis also saw significant spikes. Despite a potential full-blown recession, some stocks may still perform well. Do remember to stay vigilant in this market environment. And of course, if you're looking for a trade alert service that will help you navigate this challenging market, don't forget to visit us at thetradinganalyst.com. We have a free trading report that we send out each Monday, detailing what's most likely to move the market in the upcoming week and when. You can find the link in the description below. That's all for today. Thank you for watching.